Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money, because schools aren't, so let's get started. So are you guys beginners to the stock market and not know which stocks to invest in first? Well, what a coincidence, because in this video we have the best stocks to invest in for beginners. Now let me first get this one general rule out there that I don't go by and a lot of people don't go by. Do not invest in penny stocks. Now, can you double, triple, or even quadruple your money very quickly with penny stocks? You actually can. However, with this high risk, high return, you could make that money quickly, but also lose that money just as quick. So yeah, you might get lucky. Maybe the first year you could triple or quadruple your money, and if you continue to do that, you could retire by the age of 12. Or you could lose majority, if not all of your money, so you have to work until you're 112. Over the long term, guys, 99% of people that trade in penny stocks and even day trading, and it might be higher than 99%, they lose money or underperform the market. I never tried penny stocks. I'm not planning on it, but there's a lot of people out there that might try to force you into it or might look into it. That's your risk. I wouldn't take it. So on the flip side, instead of investing in companies that basically no one knows, that's kind of what penny stocks are, we're going to invest in large companies that everyone knows. It's a simple concept. So we have big companies, which means if they're bigger, they're safer. They've been around for years. They're probably not going anywhere anytime soon. They also have growth involved, and most importantly, for the long term. We're not going to be holding this for a week, a month, maybe not even a year. We're talking years and years and years to make money that way. What I don't want to put out there for you guys is unrealistic expectations. Now, yeah, 1 year you might be able to double your money. That's possible. However, to do that for the long term, like every single year, that's just not realistic. We do want growth. Obviously, we don't want something that's too stable, because then you'll get discouraged and you're not making much. And you definitely don't want something going down. So starting off with the biggest company there is today, guys, is Apple. Apple is, you can see from this chart, the market cap there, they are hovering around, at this point, around $800 billion. They have the chance of being the first $1 trillion company. Now, I would suggest them for definitely the first one that we could look into. I'm not saying for these stocks to buy them or to stay away from them. These are examples to get your mind going. But Apple is the biggest company out there. We all know them, and most people have their products. So looking back at the chart, you could see in the short term there are ups and downs. However, when we're looking at the long term, I have the chart set for 5 years. For 5 years, they returned over 60%. Now, 60% isn't incredible. However, it is good. If we look for a little bit further, for 10 years, they returned over 500%. So you definitely have to look at the long term, guys. It might not be able to go up very quickly in a year or two, but keep the long term in mind. Again, we're choosing Apple because they are the largest company out there. So many people have them because smartphones, tablets, laptops, that's like the thing right now. And of course, I don't see this type of technology going anywhere anytime soon. So for 5, 10, probably longer, that many years, should be good. So the next company that we're looking at, kind of similar to Apple, is Google. Now, they do have their own phones and technology type of thing as well, but they're also with the internet. Of course, they have their search engine, they own YouTube, So they're huge, obviously. You could see the market cap here, $600 billion, and the 5-year chart. Very, very nice. Again, in the short term, could have ups and downs, but we have to focus on that long term, guys. In the 5 years, they went up around 150%. So that's the cool thing too, guys. Even with this huge company, 150%, you're able to more than double your money in 5 years, even with large companies. So if they're growing, stay with them. And even if we look out 10 years ago, they're up over 200%. So since they are a tech company with the internet's definitely not going anywhere anytime soon. For the long term, 5, 10, even 20 years, guys, it's going to continue to grow. So the next big boy that we're going to be looking at, guys, is shying away from the tech industry and going into everything else. We're looking at Disney, guys. Their market cap, $150 billion. Again, for their 5 year, they are up from 5 years ago. Recently, they did take a hit. Still up, though. For 5 years, they are up 80%. Now with Disney, around forever, every single person knows them, including children. Every child has seen a Disney movie. They go to Disneyland, bunch of movies, the amusement park, of course, and they just bought Star Wars. So they've been growing forever, essentially. For their 10-year, they're up over 180%, guys. Now, the difference between actually Apple and Disney have a thing called a dividend. So they actually give you money for just holding their stock. The price could go up, price could go down, you get dividends. While Google doesn't have a dividend. So going back real quick, guys, first looking at Apple, you could see down there their dividend yield. Right now they're given around a 1.6%. Then moving over on to Disney, going down to the dividend again, they're around the same, around a 1.6%. And moving up on to Google, they do not have a dividend right now. Now, if a company does provide a dividend or does not provide a dividend, doesn't mean that they're a good or bad company. Now, when you hold them and you get the dividend, you could reinvest or use that for something else, so that's good. But a lot of people actually believe that if they do not provide a dividend, they're able to put that back into the company to grow wherever for development, expansion, more Star Wars movies. So don't think that if they don't give you a dividend, it's a bad company. It could actually be the exact opposite. For Google, they could put that back into the company to grow more. So we've been looking at big companies, guys. They've been around for years. So instead of picking, I'm going to switch it up slightly now. Instead of picking individual companies, we have, boom, Berkshire Hathaway. This could be an interesting choice because Berkshire Hathaway is first owned by the billionaire Warren Buffett. He's been investing forever, essentially. But he has multiple different companies, guys. So, for example, he does have Apple in his portfolio. He just bought it recently. He also has Procter & Gamble. He has insurance companies, railroads, gas stations. So instead of having just one, he has a bunch. And during the 5 years, it more than doubled, 105% return. Now here's another type of his shares. Most of us probably can't afford this, but I just want to put it up there to look cool. But it is the same exact company. They're just different shares. This is the A shares, and the cheaper ones are the B shares. Same company. But for the 5 years, they returned 130%. So definitely more than doubling your money. Again, if you don't want to pick individual stocks, you could diversify a little more, meaning you have multiple stocks in one investment, like Berkshire Hathaway, or the next one, which is an index. So this last one I'm kind of cheating because it's technically not a stock or an individual company, but an index mirrors the market. So this is the S&P 500 index. It is 500 of the largest companies in America. You could see again in 5 years it's up very nicely, I may add. So a lot of people try to outperform the market, guys. The S&P 500 companies, that's basically the market. People try to beat that. In many instances, they don't. So a lot of people, including Warren Buffett, actually suggest instead of picking individual stocks, just buy an index fund. It mirrors exactly what the market does because it is the market. I mean, it's not going to have any crazy gains, but it will work for the long term. Again, as we look at the chart, the 5 years, they have returned around 70%. And even in the 10-year, it actually was a little bit lower since the crash in 2008, but it still returned around 60%. So you can see with all these examples, guys, you have to hold them for the long term to grow it very nicely. A lot of people say the average return of the market could be maybe 7 to 10% a year. Again, it's not doubling it every single year. So I would definitely suggest these types of stocks or funds for beginners just to get started, see how it works, and to gain money for the long term. Not quick gains that you'll eventually lose money later on, but to continue to grow forever. If you did like this type of video, guys, I do have another one going over stocks to invest in for 2017. If you're interested, I'll leave a link in the description for you. If you have any questions, comments, concerns, leave them down below. Love to hear what you have to say. And don't forget to subscribe to my channel, guys. Real Life Money, where we talk about real life and money, because not many people do, guys. So thank you so much for watching, and I'll see you in the next one.